Right, we're here with my man Blake Timmons. He is a financial advisor, helps run the brokerage at Primerica. Been in the business for a while now. I've known Blake, man, since we were little kids, running around on the basketball court, trying to compete with each other, playing basketball together as well. And knew him through high school, then through college, then reconnected, to play flag football. And man, so we've kind of reconnected, rekindled that friendship over the last few years, and it's been good. But today we're going to talk about the financial side of getting ready for your real estate transaction, and then beyond, what you can do after the fact, after you've purchased your house. And so got a lot of information for you. It's going to be awesome. It's going to be very informative, but we're also going to keep it entertaining at the same time. So
let's do it, man. So glad to be here.
Yeah, awesome. So Blake, man, how'd you get started? How'd you, give me your, let's take it back a little bit.
Yeah.
Let's talk about, man, when we knew each other growing up, right? So I know that you were always involved in sports. Kind of pick off or start off from high school, right? So either when you graduated and then where you went and where your life took you after that, or if you want to pick up, after college, then that's fine as well.
Yeah.
So give me a little bit of background about who Blake Timmons is.
Life story.
Yeah.
Well, I'll start January 6, 1984.
Abbreviated version. Yeah, there we go.
So I played college football at McMurray University.
Yep. Which is where?
In Abilene, Texas.
All right.
There's 3 colleges there. There's Abilene Christian, Hardin-Simmons, and McMurray.
Right.
McMurray's the worst one, or we were back then.
Yeah.
I think they've come up a little bit since then. But so when I was just, man, all I cared about was football, and I felt like I matured a little bit late physically, and thought I had a chance, to go and keep on getting better and play professional. So
sure.
Right out of high school, I became a football coach, and my degree was physical education, so I was a football coach and a PE teacher. Mm-hmm. And I loved coaching football. I knew pretty fast that I was not going to be a PE teacher for much longer.
Yeah. What grade were you teaching?
So I was certified all levels physical education. The role that Dallas Christian had for me was elementary.
Okay.
So I was head junior high football coach, would go and teach little kids all day PE, and then I'd go back and coach JV and varsity football in the afternoons. It was crazy.
You covered the full gamut there.
Oh yeah, absolutely. It was a crazy time. Making no money.
Yeah.
So, but I loved it. But so after that, the next year, and I was still interested in playing football. Just know who Blake Timmons was, coming from a Division III school.
Of course.
So I became a personal trainer, got my personal trainer certification, continued to coach football at Dallas Christian part time. And that time I got a chance to play arena football. I walked on some arena football teams and worked my way up. There was a team called the Frisco Thunder. Played there. Had a kind of the story of my football life is just injuries every year. So I got a big injury, was out half that year. The defensive coordinator invited me to go out and play for a team in San Angelo. Went out there, blew out my knee. Then I did there used to be a Michael Irvin show called Fourth and Long.
Oh yeah.
That I was actually
shout out Jesse Holly.
Jesse Holly, there you go.
Yep.
So I was actually they were only going to pick 6 DBs out of all this stuff. So I went out to Pasadena and did all this stuff, and they gave me a call and they said, "You're the number 7 DB out of 6," which that ticked me off because there's just, because it's a reality TV show too. So there's this one dude that was had no talent at all, but he was always causing fights and drama. He got kicked out after the first round. I was like, that dude took my spot,
You think that they told everybody that, though? Or you're the number 7? Or do you think that they were
No, I think they said you're the number 1 alternate. If somebody goes down, you're on it. Yeah.
Man.
So, and they still would call, because they were based in California, they called me up to try to get all these football players out to the Cotton Bowl, because there was all these scrimmages. So I still played in those scrimmages on the show.
Yeah.
So it was a fun experience, but.
That's cool. I didn't know that.
Yeah.
I had no idea about that. That's awesome.
Yeah, I don't talk about it very much.
Yeah.
I guess because I'm still kind of ticked off about it. Yeah. But went out to San Angelo, blew out my knee, and then I played a little bit more in Tulsa after that. But that was kind of.
How old were you then? When you shut it down for the last time?
Well, technically, I didn't shut it down then. I worked for Nike for a little bit. At that point, I got an opportunity. But then I actually went back and tried to I was done with arena. I was going to do CFL, but I was 30 at that point. My knee was so bothered. I had another knee surgery.
Right.
San Angelo was about 26, but I kind of kept the dream alive till I was 30, I guess you could say.
Yeah.
So after that, knew I needed to actually, get a real job, and so did some Nike stuff in between the football. I knew I didn't want to do that for a career, so I ended up going and I guess going through the interview process for the Dallas Fire Department.
Okay. Yeah.
And so that took a while. And so when I was 33, I got on with the Dallas Fire Department.
Okay, sweet.
And so my uncle was a fireman for a long time, and so kind of grew up around it, and knew it was, kind of needed the next, I guess, physical adventure in my life. Even though I've had 8 surgeries now, so I don't know how much more physical adventure I'll take. But
what do you got? Where are the surgeries?
Ankle surgery, hip surgery, knee surgery. Between all those 3, I've got 8 built up between those, so it's different.
Wow.
Yeah.
Yeah,
so,
yeah.
anyways, so still a Dallas fireman right now.
Yeah.
And then, my wife was a school teacher. I was a fireman, and, we love making an impact on people's lives. But I also had this entrepreneurial spirit. We want to be able to make money. I want to be able to give my kids and my wife good things. I want to be able to have time freedom.
Right.
And so we're looking to start our own business. And so actually found an opportunity through Primerica to start up our own financial brokerage franchise through that. And so we've been doing that for a while now, and we're loving it.
Yeah, awesome, man. That's really, really cool. So let's dive into like the topic of real estate, right? Because I'm sure that people come to you a lot when they say, hey, my finances, or you make the appointment, you say, hey, let's talk about your finances. Tell me a little bit about yourself. Like, what are your goals, right? Well, one of the goals, no doubt, is, hey, I want to buy a house, right? So let's say they come to you before they come to any other real estate agent or real estate mortgage person, and they say, hey, I want to buy a house. Where do you go from there? Like, what do you say? Hey, okay, well, this is the first step, right? Right.
Yeah, absolutely. Well, obviously, we know that they're going to go to their realtor, their loan officer, and they're going to be looking for, their DTI, the debt to income, their credit score, things like that. So we need to see and kind of look at. I have this sheet that I go over with them and kind of lay their finances in front of us, and we'll just help them out as much as possible. And so most of the time, most of America struggles big time with debt. Right. Especially around here, around Dallas, where you see everyone feels like they need to drive a Mercedes-Benz, even if they're only making $30,000 a year, right? So
for sure,
that debt builds up on you. And man, I feel like I'd be a big advocate for starting financial classes in high school, because there are very simple principles that are not hard to understand. That for whatever reason, it's almost start a little conspiracy theory here. Why do they not want us to know this stuff?
Yeah, sure,
kind of deal. But it's just simple stuff that I've learned since I got into finance that it didn't take a genius to understand.
Right.
So I love sharing those principles with people.
Right.
So
what is it? I think that I can't remember who said this, but it was financial literacy is like 20% knowledge, 80% action, basically.
Yeah, absolutely.
Right?
Yeah, you got to have the discipline to do it, right? I can teach somebody something all day, but if they don't have the discipline to actually not take money out of their savings account every year or every month and put it in their checking account, then I can't help them out, right?
Right.
So, yeah, it doesn't the knowledge it's important, but a lot of people have knowledge. It's the right, and that's life.
That's right.
Right. A lot of people know how to dribble a basketball or whatever in sports, and they just don't go out and practice for as long as the greats do.
Right.
You got to have the discipline and the want to do it.
For sure.
But so we would sit down with somebody, and we would. We look at things like, well, let's start with this. So the average American income, the average American household, their finances.
Husband and wife.
Husband and wife, right? So 61% of this piece of the pie of their finances, 61% goes to living expenses.
Okay.
38% goes to taxes, debt, and insurance. And about 1% goes towards savings. And that's right? The average American family, if they're bringing in $6,000-$7,000 a month between 2 incomes, you can almost guarantee that their expenses are $6,000 and $7,000 a month, right? And maybe even a little bit over that. So they're paycheck to credit card to paycheck instead of just paycheck to paycheck.
Right.
And that's how you don't even feel like you're trying to, you didn't go out and buy this expensive car, but at the end of the month, there's, too much month at the end of the money.
Right.
And all of a sudden, you just have to use a little bit of a credit card, and then you look back after 3 years and you're in all this debt and you don't know how to get out of it.
Right.
And so I really enjoy teaching people how to do that, because a lot of times they kind of given up on that aspect. They're like, I guess I'll just be like this for the rest of my life, right?
Yeah.
And they're always going to struggle to buy a home or buy a car. They're always going to have high interest rates.
Yeah.
And so anyways, what we do is...
Real quick.
Yeah.
If you don't mind. What do you think those percentages should be? You said 61% is expenses, 39% or 38% is, taxes and insurance and all that stuff, or debt. Like
Yeah.
where do is there a number that's like, okay, well it should fall in here as far as like you should keep your expenses at 50% and you should keep your like no debt, right? Obviously, right? If you want to do that, but you know, taxes and other things, like where is there a number that y'all strive to hit on those?
Yeah, and I mean it depends on your situation as far as how realistic certain goals are.
Sure. And what type, like, are you a W-2 employee? Are you a self-employed person, like something like that?
Yeah, absolutely. So the living expenses should definitely optimally be down under 50%.
Right.
Right. And optimally the savings would be at least 25%.
Not 1%.
Yeah, not 1%. Right. So if somebody can maintain their living expenses towards down under 50%, it just gives them so much more leeway to start saving money, to not have the debt, or to pay off debt aggressively, things like that. But so typically what a financial advisor will do, he'll come in and say, all right, he'll sit down with somebody, you know, they're getting ready to buy a house or whatever, and let's get you ready. And so we'll say, we really need to aggressively start paying off this debt. Mm-hmm. And also, along with that, we need to start investing money, start saving some money.
Right.
And so typically that'll cost about $800 to really put that in place. And, you know, the average American family is saving 1%. What do you think they say to that?
Right. Yeah, we don't have that.
Yeah, they say, get out of my house. You just wasted a lot of my time. Thanks a lot for making me feel horrible about my circumstances, right?
Yeah.
And so instead of looking at living expenses, they'll say, hey, you need a carpool to work. You need to start eating out so much. We don't mess with that. We look at just the hardcore taxes, debt, and insurance, the other 38%, right? And most people overpay on their taxes. This is kind of a one-off. The average American got $3,000 back on their taxes last year.
Right.
So, and they're all happy about it. Yeah. Right? Like, oh, sweet. Got $3,000 back and go on that vacation, or I can buy that big screen TV. Yeah. Right.
And so your recommendation is?
Well, you want to break even on your taxes.
Right.
Because what really happened when you get $3,000 back on your taxes is you just gave the government an interest-free loan. Who gives out interest-free loans?
Yeah.
Right? You gave the government an interest-free loan for an entire year. Right. They went and got invested it, and they know how to invest it. They get 10, 11, 12% back on your money, and then they give you back $3,000 and expect you to be happy about it. Right? That's for some reason they have all of America convinced they should be happy about handing out interest-free loans. Right. Right. And so
that's wild. Yeah.
So if you have a different mindset about it, that $3,000, this family that is too much month at the end of the money, now $3,000 at the end of the year is $250 a month back in their paycheck every month, which is huge.
Right.
So that's just changing somebody's mindset on that to be like, hey, you don't want the $3,000. That's your money.
Yeah. Right.
Right. That's not free money. They just hand it out. They just borrow your money.
From the get-go, it's your money. You paid them that money, and they just gave it back to you.
Yes.
Right. Because you overpaid.
Exactly.
Yeah.
And they're like, oops, sorry, here's your money back. So, so just teaching, and this is not hard. I'm not a CPA. Right. This is not hard stuff, right? Most people don't know. Most people think on their W-4, they'll look at the kid and they'll claim one per child.
Right.
Right. Depending on what income bracket you're in, you can claim 4 per child. You may have 2 kids. You can have 8 exemptions.
Right.
And people have no idea. They thought it was 2. Different income bracket, it may be 2 exemptions per child.
Right.
But it's little things like that again, I'm no genius, right? I'm a fireman got into and it's just simple stuff, right? It doesn't take a genius to do it. For some reason, they want us to think that it's pretty complicated, so we won't mess with it, right?
Right.
So taxes is a big thing. Most people don't pay off debt the right way. They don't know how to do it.
Right.
Sat with somebody last week, and just by teaching her, and it's you're familiar with Dave Ramsey, the snowballer. It's also called debt stacking. We're big on that, but we actually have a program that we stick into the computer once again, where I don't have to be a genius.
Yeah.
Put the program in, and it tells you how to pay it off and exactly what to do, and it's foolproof.
So your recommendation does kind of follow the debt snowball or debt stacking, where it's like, instead of, okay, you've got a credit card that has $10,000 on it, and then another one that has $5,000 on it. The one that has $5,000 might have a higher interest rate,
right?
Or no, might have a lower interest rate, but you want to attack that $5,000 card first, right? Versus that way you can snowball that one onto the 10,000.
Typically you'd start with the ones that are lower, and so then you're done with it, and you can snowball. You keep that. Say you're paying $500 towards your debt. You're going to continue to pay that $500 until all the debt's paid off.
Right.
But what we do is, if we can find some extra money, like with the taxes, right, and then I'll talk about insurance also, but Like on average, I can find $500 a month
Right.
for somebody, just on average.
Right.
Right. And it depends on different people's situation. Maybe less, and maybe a little bit more.
That's so crazy because you're exactly right. I do feel like the amount of waste or amount of money that goes into other places that it shouldn't is crazy in the average American household. And I'm guilty of it too. I'm sure everybody's guilty of waste, right? But you're talking about, hey, you paid $250 every month that you didn't need to pay in, or you're paying off your credit cards in a way that's not advantageous for you, to where you can save this money or pay one off faster and then use it to add it to another one. So now you got $250 a month from the income taxes that you saved, and then you have the one debt that you paid off that gave you another $100 a month or $200 a month, $250, to where you're saying you can find $500.
Yeah.
And add that now to what you're paying for your higher credit cards. Man, that's some
absolutely
insanely powerful stuff.
Well, and this is, I mean, just do us, I used to be, all I cared about was large numbers. At the end of the day, I just wanted to see, wanted to make a bunch of money. But now I can see, and this is, I think most people are like this, how quickly little tiny numbers add up to really big numbers. So I sat with a lady last week, and even before I did anything else, I was able to she was overpaying me. So you go into someone's debt and you see if they're overpaying on any of their credit cards, right? Because most people think, there'll be the warning on the credit card. You go on to your Bank of America website or whatever it may be, and they'll say, there's a warning now, right? It's like, just so you know, if you keep on paying the minimums, it's like we're obligated by law to tell you you'll be in debt for the rest of your life.
What is that? Oh, so I didn't know about that. Explain that.
Well, they're saying that if you pay the minimums,
right,
that it will cost you this much interest. So they actually give you a little bit of the financial advice there,
right.
They're so good to us.
Yeah.
But so most people will throw a little bit more money at it instead of just paying the minimums. But if you just kind of take a scalpel and skim off all that fat that they're paying there, pay the minimums. So you have 5 credit cards. Pay the minimums on all your credit cards. So if I just go and find out that they're paying a little bit extra, I found $50 extra there before I've ever done anything else.
Right.
$50 extra on this one credit card, and then you get the debt stacking rolling. She was going to be out of debt 10 years sooner, which saved her thousands of dollars in interest. Then the debt's paid off. She can start attacking savings and it changes their financial life just based on $50.
Yeah, right.
So things like that are eye-opening.
No doubt about it. I cannot stress one, being out of debt in general. I remember, after I came home from college and wasn't making much money, and so I was swiping that credit card just like a lot of college students were. Because when we were going to college, by the way, it was credit cards. Companies were on the prowl, man.
Yes.
They were, hey, here's a college T-shirt. Sign up for our credit card.
Yeah.
And we signed up for some credit cards, boy. And now I do think, some people might not agree. I do think credit is good in my line of work,
absolutely,
right?
Yeah.
Like you need some leverage depending on if you're going to be investing or if you just want to buy your home. You have to have credit unless you're paying all cash. And if you're paying all cash, hey, great, more power to you. That's fantastic. I love that too. But the majority of people, overwhelming majority of people borrow to buy their house, whether it's they borrow 80%, 90%, 95%, they're more than likely taking out a mortgage on the property. And so having credit set up is important, but having debt is a lot of debt can be an absolute disaster and ruin your chances of buying a house. And so
yeah, absolutely.
After you snowball, so we're talking about buying a house, right? So after you stack all the debt and you get that all paid off, where do you attack next, right? I mean, I know at that point maybe you're like, okay, you can go talk to a lender or realtor, or it can be simultaneous as well. But what are your next thoughts?
Let me touch on something you just said, talking about credit being important. And some people I know. Some of the experts out there will just say, you don't even need credit. You just don't go into debt. That's your, that's your debt loving score is, we'll call it.
Yeah.
But so I had an old buddy, his dad actually ran a bank, very, very wise. And so, but what he told his son, he said, be a debit card man. Don't be a credit card man.
Right.
Which is, probably used to be sound advice, right? Don't use money that you don't have is what he's saying, which is sound financial advice. But in order to build your credit, basically, you need to kind of switch that philosophy around. Be a debit card man, but just use a credit card so you can build your credit. Just pay it off.
Yeah.
Always pay. And that's where you talked about the 20-80 rule. Most people don't have the discipline to do that.
Right.
And so you probably shouldn't go and open up 10 credit cards.
Right.
But it's absolutely important at a young age, and parents can help their kids with this, to teach them it's sound advice to make sure that you never use money that you don't have, especially when you're young.
Right.
And you're not buying a house or cars. There's no reason for it.
Right.
But if you will treat your credit card like it's a debit card and always pay it off, you'll have a really good credit score at a young age.
Absolutely. And we don't have to go into it, but there are perks whenever you do things that way, from a standpoint of free travel or like cash back or whatnot. So ways to actually make smart decisions and improve your financial situation based on doing it that way. The scary part about that is the execution, and are people able to do that? And then the what ifs of you get in a car accident and that month you can no longer pay the credit card, and then it starts to add up. You could make an argument on the flip side of that also, that, well, if you get in that accident and you don't have your savings built up, then you'd be in debt anyways, right? So that's going maybe to your next step.
Yeah, that's another good point, what you just touched on about how debt's a cycle. So a lot of people, if they're given the option, say they have debt and they know they need to save money also, and they're given the option, most people will actually choose paying off debt, right? Because they don't really feel like they can save any money when they're in all this debt. But it's actually good. I mentioned in the beginning, it's good to do both at the same time, and it's easier to do that if we, are able to free up some money with taxes, debt, and insurance.
Right.
But so when, let's say, for instance, I'll see all some of the things I follow online. They'll post this awesome picture of being out of debt, and their hands are in the air, and they're having a party and a parade for them, and all this, which is awesome. That's all more power to them. That's a great day when you're out of debt like that, especially when you just you felt like you had these chains on you for so long, no telling what their story is.
Right.
But a lot of people now, let's say they got out of debt, and let's say they attacked debt and they didn't put any money towards savings. Right. This is where debt starts to be a cycle. All of a sudden they got out of debt, hooray, and then the kid needs braces, and then the car breaks down, and then the washer breaks down. All these little things that are just life. It happens to everybody, right? Now all of a sudden you don't have any money saved up. Right. You need $3,000 like that.
Yeah.
And all of a sudden you got to borrow again, and debt becomes a cycle.
Yeah.
So we strongly advise pay off the debt. You can start saving at $25 a month. Just something. Right. Start putting some money away. Start having your money work for you. And at that time, say during that time you were able to save $3,000. Now instead of borrowing your money, you have your own money, and then you're not going to feel too great about it because you worked hard to save your money. But it's great at the end of the day because that's the reason you put it away. It was your emergency fund. You were trying to build it up, and now you need to use it, and now you don't have to borrow anymore. Right. And then
so that cycle stops.
The cycle stops. Right. Absolutely.
And that's awesome. So talk about insurance. How you can maybe find some money in insurance.
Okay. So like I said, we'll look at somebody's taxes, debt, and insurance. Insurance, man, I can talk for a long time about this.
Yeah, give me the highlights.
Yeah, I won't get into all the details, but we are huge believers in term life insurance. Okay, so and there's a lot of little details and minutia that goes along with all these different insurance details, but as a whole, the reason is the other kind of life insurance typically is something called cash value life insurance. And so with cash value life insurance, it's sold as they'll come and sit down with you and be like, hey, John, would you agree that you'd be, saving money? That's a good financial principle. You need to start putting money away, right? Right. I'm like, yeah, of course. It's like, okay, well, would you also agree that you need some income protection? You need to, save your family. If something were to ever happen to your family, God forbid, that it would not be financially paralyzing. So, have some insurance in place, some life insurance. It does sound great. Yeah. All right. Yeah, it sounds absolutely great. Who would want that? Yeah. But so step back from insurance for a second. Let's just talk about sound savings principles. Let's say if you were to walk into a savings, you walk into a bank, and you said, "Man, I got some money. I'm going to start putting $100 a month into this savings account. I'd like to open up a savings account with Bank A." And they said, "Fantastic, John. Yeah, we'd love to take your money. The only thing is, we don't expect to see you back for the first 3 to 5 years, because until then, the account that you're putting $100 in a month is going to reach zero." Right. Okay. Would you do business with that bank?
Doesn't sound great.
Yeah. So after 3 years, and this is as a whole, it can be 2 years, 6. I've seen one 10 years. He didn't have any money in it, so they're all over the place. But at 3 years, if you were just stuffing money under your mattress, you'd have $3,600 saved up. Right. Right. But you chose, thought you were being wise and started a savings account, and you have $0. You can't recover from that in any investment. Right. And so the other thing with cash value is that at the end of it, you're paying for two things, right? Money's supposed to be going into the cash value. Money's going towards the insurance.
Right.
And at the end of, well, let's say it comes up and God forbid somebody passes away, and that's what it's there for.
Right.
Your family gets to decide if they want the cash value or the death benefit. They don't get both.
Right. Okay.
So
explain that just a tad bit, like layman's term, cash value, like what you've put in.
Yeah. So the savings account. So when that savings account analogy I just said was what cash value life. That's what cash value life insurance does. So basically, cash value life insurance is saying you have a savings account and you have a death benefit in the insurance policy. The death benefit, if someone passes away, that money pays out. So you have $500,000. Your wife and kids now get $500,000 to help ease the financial pain and to try to figure out something there. But that money was also going towards a savings account. So you think savings account, that's all my money. Right. They don't think that. They think it's their money. Right. And so if you were to pass away, let's say you had $500,000 in life insurance and you had $250,000 in cash value built up. And they said, Mr. Jacobus, which one would you like?
Yeah.
What would she choose?
Yeah, so 500.
She'd choose the 500,000, right? And said, okay, well, we're just going to keep the 250. So usually, most time, if you're paying for two things and you only got one of them, what would you call that?
Yeah, well, I got ripped off, is what I would say. Yeah,
that's what I would say too. And I can go into more details of it. I won't go into too many more details about it, but.
So explain the term then, the term life insurance.
Yeah,
right?
so
believe in
the
that.
big thing is, and this is why we save money, cash value life insurance is way more expensive than term life insurance. And so what we say is buy term life insurance, right? Which just means insurance and insurance. The whole point of insurance is in case stuff happens, right, you're insured, right? So let's say if you passed away, you had $500,000 in coverage. And that means we can actually take that $500,000 and now we can create income with it by investing that. Right. And now your wife and family have just replaced your income. No replacing John Jacobus, but they replaced the income, right?
There we go. Absolutely. 100%. I appreciate that. Yeah.
I've sat with husbands before. They're like, I don't want her being all, going and find some other sugar daddy,
Yeah, I know, right? Yeah, she's got all that money
all
now.
that money now, yeah. I wouldn't advise thinking that way, though. But So because insurance is just the insurance, that's all it is. Term life insurance is much more inexpensive, like 10 to 20 times sometimes.
Right.
And so what we'll do, we'll take that money and we'll actually do something crazy. We'll invest it in real investments. Yeah. Right?
Crazy.
It's crazy. And so on those real investments, you can go and you can get, 9, 10, 11, 12%, just like the bank does to your money when you invest it and they don't give it back to you, right? They give you 0.03% on a savings account and they charge you 20% interest on a credit card. That's how they work. And then they take that money and they make millions of dollars off your money. And then I'll go over that a little bit later, the rule of 72.
Yeah.
But so if we just take the money we save between the insurances and invest that money, it is, it's crazy. And so now it's both yours. Right. So now let's say you got $500,000 in life insurance, and then over the years it's going to be way more than the 250. It's going to exceed. It may be $750,000 saved up, and now it's both yours, right? You put that in your will. If you were to pass away, now your wife has the 500 plus the 750,000.
And so basically, what you're saying is that guy the Jacobus family has $100 that they can apply to their insurance, right? Let's say my term life insurance. Give me a number that would for a 35-year-old guy, like relatively healthy. Like, what would you say would be a potential just a round number that is it $25 a month for term?
Premium?
For term.
Yeah, so $500,000 policy could be $50 a month.
Okay, so $50 a month. So instead of going $50 a month for the term, so you go $50 a month for the term, and then you invest the other $50 is what you're saying. Don't then put it in the whole or the cash value insurance. Then you create that investment is what you're saying.
Yes,
right? Because that whole life or cash value insurance would have cost you the whole $100. Now you can take 50 of it, apply it to the term, take the other 50, and make it the cash, or make it an actual investment that's going to bring you a return.
Exactly, right? It brings you a much bigger return because you're actually the real investment. It's designed to bring you, between 7, 8, 9, 10, all the way up to 12%. Right. But then also, they're both yours. You paid for two things and you got two things, no matter what. Whether if you stay alive, then you didn't spend too much on life insurance, and then you have $750,000 or whatever it is saved up to enjoy.
Right.
But So yeah, it's buy term, invest a difference. It's a lot better overall philosophy, we believe.
I got suckered into the cash value.
Oh no,
initially.
tell me it
man.
ain't true, John.
Yeah, it is, man. Whenever I think I was 25, 26 or whatever, and full disclosure, still pay it now. I mean, I don't know if it'd be better. You could tell me if it'd be better just to pull it out. Because can I just pull it out now, or am I kind of locked in on that? Or
no, you can pull it out.
Yeah. So, so I got locked into that. I say locked in. I did that, and thinking that I was doing the right thing, right?
Yeah.
Like because they're like, hey, they sold it to me, and I was like, dang, that sounds, you know what? That does sound like the right thing to do, right? Like, I need to be putting money away every month. It's like kind of like a savings account. At some year it'll flip, and so now it's more of like an investment account, whatever. And,
absolutely.
And so. I got sold that. There's no doubt about it.
Hey, most of America has been sold.
Right. So, and I still have that. And it's one of those things, and we've talked about this before off camera. It's kind of like it's out of sight, out of mind. Yeah, it comes out of my bank account every month, but it's not something that like I'm hurting or I'm like need that money right now. And so it's like it's going towards something that's better than me just blowing it on, going out and having some drinks. But is it really the optimal thing for me to be doing?
Right. Yeah, and I mean, you said it, out of sight, out of mind. You just don't think about it.
Right.
The better way to have the out of sight, out of mind philosophy was all that money just from there going towards an actual savings account. Then it's out of sight, out of mind, and then you look back and you got tons of money saved up.
Right.
As opposed to, eventually with cash value, sometimes your cash value can get depleted because your premium can go up and they start.
Oh, right.
Yeah, there's a whole lot more details there that we could go in, but we don't want to bore the audience. So.
All right, so let's go back.
Yeah.
To like the house buying. So you've got the client that comes to you and says, hey, I'm looking to buy a house. Give me some action steps. So you give them the action steps of let's attack the debt. Let's talk about your taxes. Let's look at some insurance to where maybe you're putting too much money towards insurance. We can eliminate some of that. We can help your savings account. So now we buy a house, right? And so they've saved up enough money for a down payment. They've talked to me. They've talked to Harold. I've found them a house. And so now we've accomplished that goal, right? What happens next, right? In your eyes, like now are we full-fledged? Hey, we're wealth building mode, or we're hey, let's still chip away at these little things. And I know every situation's different.
Yeah.
But once you buy a house, you're out of debt. You're taking care of your taxes the way they should be taken care of. I don't know if this is where you want to talk about the Rule of 72 or if it applies or, whatever, but I know you said you were going to mention that later. But
yeah.
So, I mean, ultimately, would that be something to where you can apply that rule after the fact, or would you go ahead and say, hey, that needs to be from the jump? Well,
if somebody, like you said, we've given them the knowledge and then they have the discipline to execute upon that knowledge, and they're financially healthy, then it's exciting because then, in a few years, they're going to be out of debt. One of the first clients I sat with was a really good friend of mine. He was going to be in debt, and we include the mortgage on debt. He was going to he was 30-year mortgage, going to be in debt for 30 years.
Right.
And we sat down with him, looked at his finances, went into, we looked at, how much he's contributing to his 401k. Little tidbit: if you don't want to contribute more to your 401k than your employer matches, right? Because you can actually get you can't duplicate somebody else giving you money in the market by doing like an IRA or something like that. But if they're matching 3%, you want to be given 3%. You get that. If you're given 6%, that 3% you're giving over, you can make more money out of somewhere else.
Right.
And so we went and
if it's not being matched, that's to clarify, right? Like if they're only go up to what they're matching, is that what you're saying?
Precisely.
Okay,
yeah. He was paying a little bit more, so we found some money there. All kinds of we found him like $800 a month. I said on average it's $500. We found him $800 a month.
Right.
And so we were actually able. He went from getting out of debt or being in debt for 30 years to being out of debt in 7.
Right.
That was including the mortgage.
House included.
Yeah. You know what? It might have been everything in 7. I think it was including the house. It might have been 11. It could have been 7. That sounds crazy to me now.
Right.
But I'll have to go back and look at it. But anyways, completely changed his financial life. Wasn't going to have a lot of money saved up. Now he's going to have $2.5 million saved up for retirement. Average American family, husband and wife, bringing in pretty normal incomes.
Right.
So we believe that just an average American family can have a couple $1 million saved up at retirement and be. Our goal is to get them to financial independence.
Sidebar here, real quick. Like, so it's so interesting to me because I look back 30 years at when my parents were my age, right? And you talk about like what they thought their needs were. Do you ever think as a financial advisor, like, man, you actually need 5 times that number, because with inflation and like the value of money, like 30 years from now, like where's it going to be? Like, what are the living expenses going to be if you are 30 years from now and you have 2 million saved up? Is that going to be enough money? Like, that's one of my biggest fears is when I get to retirement, I don't have enough saved up.
Right.
And my answer to that is, I just need to make more money.
Yeah.
You know? And so
right.
I don't know what that number is, like, truthfully, but because I think that so much the housing market changes, right? In Dallas in the last 8 years, a house that you used to buy for $200,000 is now trading for $400,000. Okay, like let's say I was 45 years old, 50 years old. I just bought a house. My house isn't going to be paid off if I take a 30-year mortgage, which could be another issue. Maybe we want to strive for the 15-year mortgage instead. But I'm not going to have it paid off until I'm 70. Like,
yeah, that's depressing.
Like how? But like, so how much money do I need? Because the taxes are going up on that house, right? And so my monthly payment is going to increase until I hit 65 at least. And then you still have your insurance might increase. And so, like, how do you know, like, okay, enough's enough, right? And I mean, is there some sort of calculation on that y'all kind of follow? And that might be a loaded question, because like it's going to be different for everybody. But like, what are your thoughts when you're working? And obviously, like, it could be too deep for right now.
Yeah.
This 30-minute, 40-minute podcast, but. How do you know, okay, at the end of the road, like, I'm going to have enough money saved up to where I can live comfortably and retire comfortably?
Well, if somebody just went on and just asked me everything that you just asked me, I may tell them that they might struggle with anxiety a little bit and have a lot of fear, and maybe prescribe them to a doctor and get them on some medicine or something.
Maybe that. Okay, noted.
But. No, and you know what? There's always going to be some level of uncertainty, right? I mean, even investing in the market, there's a certain level of uncertainty, right?
Right.
But we can look back at the past and say, if the market does, I'll tell this people all the time, if the market does, and it gives them a little bit of peace of mind, if the market does as bad for the next 30 years as it has for the last 30 years, you'll make 9% back on your money.
Right.
Right. And so we can look back at history repeats itself, all that kind of stuff. But, I mean, to sit down and make like a detailed financial plan, you can sit down with somebody and say, what does retirement look like for you?
Right,
What are your goals? Is your goal to, move to the Bahamas and buy $1 million house out there? It's like, yeah, well, we need some more money.
Yeah.
Right. Or is, are you just cool here? Your mortgage will be paid off. All you'll be doing is paying taxes on your home. And, you're happy with this little life you nested for yourself. And, this amount of money will be, and we can say, hey, this amount of money will last you until this period of time.
Right.
You might be dead then, you might not be.
Right. If not, you need to kick the bucket sometime. I'm just
you should aim to die just around here.
I know, right? That's what my buddy's, I think his term policy, and we talked about this, but he said it's like 70 years old or whatever. So it's like 69 years old and 364 days. Boy, I need to figure out if I'm moving forward or if I'm going backwards, like.
Well, and hey, and that's we're talking about this now, so I'll talk about this. A big like financial building block is called the theory of decreasing responsibility. Okay. And so what happens there is you have people can't see this. We can share some of this stuff.
Absolutely, yeah. We'll link it up wherever. If you're viewing it on Facebook, like we'll figure out a way to link it up. And if you're viewing on YouTube, obviously, like down in the comments or the description, like we'll link up this very PDF that he's going over here.
Okay, awesome. So I'll look at my screen here, and so basically, it's called the theory of decreasing responsibility. This is a big deal we teach to get to financial independence. So early on in someone's life, that's newly married, they're starting their new jobs. Eventually they have young children, they have mortgage, they may have student loans paid off. Right, they have a lot of liability. Mm-hmm. So that means they don't have a lot of money. And they have a lot of liability. That means if something tragic were to happen, it would be financially crippling. Right? It would be paralyzing to a family. So if, like we said earlier, they're making bringing in $7,000 a month between the two of them. If one passes away, you say that's tragic. They lost one parent. They probably lost both parents because the other person's got to go get another job now. Right. And so that's one of the deals with income protection. But so when they're down here at the bottom, like I said, they have a lot of liabilities, not a lot of money. But the goal is, as life goes on, will they be able to see it if I do this?
No.
Okay.
No, they won't. They won't. But He basically drew an arrow that ultimately it started from the bottom. Now we're here. No, it started from like you have more responsibilities till later on you have less responsibilities.
And so this
financial responsibility.
Yeah. So this bottom line right here is your income, your money making potential, and as you get older, hopefully hopefully that goes up. Right? No, you said it right. So hopefully that goes up. So you don't have a lot of money down here, and as this arrow goes up to the top, you see it says you better have some money up here. And so, John, every good offense has a good what?
Defense.
It has a good defense, right? And so up at the top, that's the defense. Like early on, you have all these liabilities. You want to have a lot of defense in place, right? But as your offense gets really, really strong, your need for defense goes down. And so over the years, you see on top, your income protection, if you have and you've implemented, you have the knowledge and you executed it and you have a couple $1 million saved up, you don't need life insurance anymore. That's called being self-insured.
Right.
Once you make it to be financially independent, then you also make it to being self-insured. And so that's another big philosophy with the term. People freak out about it. It's like, well, it only lasts this long and stuff like that. And you can re-up on your term, you know, also. But our goal is to get you to a place where you're financially independent and you don't need life insurance anymore. Right. You don't have to pay for if stuff happens because you saved up if stuff happens.
Which is why you don't, like, another reason not to do the cash value is because, like, you don't need to be paying that expense for the little money that is going to be returned, right?
100%.
Yeah, so that term, man, you've only invested a tad bit of that money, right, or a fraction of the cash value. And, yeah, so it expires, but you don't need it because you've taken all the rest of the money and put it into those investments that have now made you this freedom wealth, right?
Exactly.
To where you don't have to worry about being insured anymore.
You got it.
Yeah.
Absolutely.
So let's talk Rule 72. What is it? What does it mean?
So this is probably, and this is one of the things that we should have learned in high school. Right? Yeah. We'd probably all be in better situations right now if we would have learned this, right?
I do agree with you. I don't know if we said it off air or on air, but man, this financial literacy in the school system, it should be there.
Yeah.
I mean, what is a credit card? I know balancing checkbook or checking accounts is like non-existent anymore.
Right.
But like, what does that even mean, right?
Right.
And then, how to save. What is debt do to you? What is saving do to you? What is investing do to you? All of these things would be unbelievable to know because these are things that you and I don't know how your family was. My family, like, very entrepreneurial and like worked hard for their money and was successful, but there were some up and downs. But there wasn't, truthfully, there wasn't a lot of like, okay, this is partly because we as kids were like, Mom, whatever, like we don't need to learn how to balance a checkbook.
Exactly, yeah.
Right? They tried, right? We just didn't receive it very well. But like, I think that knowing this stuff would create a nationwide difference in how the country is run and how much debt we're in and the economy and all that stuff.
100%. My conspiracy theory on it, I'm not a big conspiracy theorist, but I'll joke about this, and I think it's probably true. I don't think banks want us to know that because banks go around off all your debt, right? They get 20% of our debt on credit cards, and so if we learn all this in high school, people don't get in debt anymore. They don't make as much money.
Yeah.
But and that's why I love though just fighting for just normal everyday people that it's getting them out of bondage. When you get them out of debt and you start learning, and this goes into the Rule of 72 right here. So this is a huge principle that we teach. So let's say we use the savings account again, right? Let's say you walk into a bank, you found the best bank in the world. They're going to give you 3% on a savings account, right? This bank doesn't exist, right? But just for the purpose of this illustration, we talk about it. You're going to give you 0.05% on a savings account, maybe, right? So, but you walk into a bank, I found the best bank in the world, and John goes up and you say, hey, I got 10 grand saved up, and I found the best bank in the world. I got a savings account here. I'm making the smart decision. I'd like to invest $10,000 in this savings account, okay? Here's what the Rule of 72 says. The Rule of 72 says, we can share this with them too, right?
Absolutely.
So you'll see right here, it says 3 goes into 72 24 times. What that means is it takes your money 24 years to double. Okay. So the $10,000 in 24 years becomes $20,000. 24 more years, it becomes $40,000. So 48 years, this $10,000 grew to 48. You're all excited about retirement now.
Yeah.
I probably would advise them that they don't have enough money saved up in that situation.
That point. Yeah.
Right. And so you invested that money on a Monday. All right. This is also called the banker's rule because of this.
Right.
On a Tuesday, the bank took your money and they know what to do with it, right? They're going to go and make 10, 11, 12% in these mutual funds that they know about.
Right.
And the Rule of 72 for them, works a little bit more in their favor, right? Because 12 goes into 72 6 times.
So you're saying then they go invest it in 12% interest is what you're saying.
Exactly.
Yeah.
And so sometimes that doesn't seem like that big of a deal, 3 to 12, okay. But, so 3 times 4 is 12. So maybe they made 4 times as much money, which would be 160.
Right.
But that's not what Rule 72 says.
No, that's not how
right?
it works.
You come all the way down here, and off your $10,000 in the same amount of time, the bank made $2.5 million off your money.
Right.
And how much did you get?
Yeah, whatever, $40,000.
You got $40,000, right? And you don't even know. You're not even mad about it because you don't know they made $2.5 million off yours.
Right. So walk through that. I interrupted you.
Yeah.
But walk through how the rule of 72 works for them when they're making 12% interest. Meaning, like, the rule of 72, whenever you're making 3% interest, 48 years, you've got $40,000. If you're making 12% interest, then it doubles every how many years?
Yeah, it doubles every 6 years.
Every 6 years.
Yeah. So you were waiting 24 years for your money to double the other way. Right. Now it's doubling every 6 years. So literally,
it doubled 4 times in the time that years doubled once.
Yeah, that 24th year, you have 20 grand in the 3% principal. You have 160 grand already in the 24. And now, in all this, the Rule of 72, it's compound interest is what it's illustrating.
Right.
It's the power of compounding, because in these later years, you go from 320 to 640 to 1.2 to 2.5 million.
Right.
You wait another 6 years, you got $5 million saved up. So it starts to really increase exponentially, is basically what compound interest does.
Would you recommend, or what are your thoughts on, so somebody has $10,000 right now, is it better to invest all $10,000 at one time, or say, you know what, I could really use that money, for something else, to buy a car or redo a house or whatever, but so I'm gonna invest $2,000 for the next five years, right? So $2,000 every year for 5 years, or 1 year, go ahead and let's get started and putting a $10,000 bump in.
Yeah. So kind of, you didn't know you were doing this, but so there's something called the time value of money.
Okay.
Right. I'll talk about that. So if you have, let's say, you're out of debt, right? If you can, let's say we sat down with you, you're financially healthy, and you have 10 grand saved up right now.
Yeah.
Go ahead and invest that 10 grand now.
Yeah.
Here's what the time value of money, and we can share this as well. So here's an illustration. Somebody evidently got some financial education at 22 years old.
Yeah.
Right. They are the maximum right now you can contribute to a Roth IRA is $6,000 a year.
Okay.
All right. So let's say that's what they're doing. So $6,000 a year from 22 to 29. They've invested $6,000 a year. Yeah. And then for whatever reason, they got stupid all of a sudden and they just stopped.
Right.
Right. It's still not that stupid because they're going to have a lot of money saved up. But so that money, they've invested zero from age 30 to age 67. They don't invest any more money. So they've only invested $48,000.
Right.
Okay. And then they just let it ride.
Right.
They just let the interest continue to compound. And so in the other illustration, it's the opposite. From age 30 to age 67, they didn't start early. 30 is still pretty decent, right?
Yeah.
It's younger than us, right?
For sure. Yeah.
From 30 to 67, they invest $6,000 a year. Okay.
For the entire time.
The entire time, right?
Yeah.
So in the first illustration, they've only invested $48,000.
Right.
In the second illustration, they've invested $228,000.
Right.
How much money do you think? Who do you think has more money?
Well, for the purposes, and I do know this. I was taught this in my finance class at A&M. Didn't take advantage of it, but the guy that invested early, right?
Yeah. So he's only invested $48,000, but he has $2.2 million saved up.
Yeah.
Right. And the other, it's nothing to sneeze at. They've invested $228,000 and they have $2 million saved up.
Right.
But it's crazy that all they did was start early, invested $48,000, and they actually have $200,000 more saved up than the people that invested $220,000 wait until they were age 30.
Yeah, and that's the crazy part, is literally that person had to save $200,000 more, right, or spend $200,000 more to get the same amount of money in the end. And you're doing that when sometimes your expenses have gone up. At 30, you start having kids, right, or you buy your house, you're repairing your house, and so it might seem like things were really expensive whenever you were younger, but I could argue maybe like right now, it was probably easier to save a couple grand a year whenever I was 25.
Oh, absolutely.
You don't go to McDonald's every single day, cook at home, and you could save a couple $1,000s.
No, and that's where, they say youth is wasted on the young, right?
Yeah,
we probably had the most potential, until our, earning potential goes, way up as we get older. But when we're young and we don't have a family, we don't have kids, man, we could have saved all kinds of money.
All
We
kinds
didn't.
of
You know,
money.
we went out and probably bought nice cars and whatever, spent it on girls or whatever.
Right.
But girlfriends, let me clarify.
I mean, I figured that's everybody the way everybody was going to take it, but that's what popped in my mind. It's girlfriends, right?
Yeah.
Out to dinner,
exactly.
and maybe a bottle of wine
there
or something
go.
like that.
Exactly.
So let me ask a question about that. So that guy, the first guy from he's 22 to 29.
22 to 29, yeah.
So he spends $48,000. At what point does the guy at 30, and I don't know if the math is on there, but the guy that's starting at 30, how much does the guy that put in $48,000 have at 30 that he would need to like catch up? So if the guy wanted to catch up right there,
yeah, he
like,
could.
Like how much would he have to write a check for to be like, okay, I know that this guy has put in 48 over these 7 years. Now he has what, 75,000 at that point, or what?
Yeah, about at age 30, he's got 80 grand.
He's got 80 grand. So that guy, that if he wanted to start at age 30 and be at the exact same point, he would have to write an $80,000 check to catch up to him.
Absolutely.
That way he wouldn't have to put in $6,000 for the next 30 years. It would, boom, he starts there, which is the same concept, right? So to give people hope, they're like, dang, I'm 36, right? So I'm 36. I didn't start back then. But maybe I have a little bit more money right now that's just sitting somewhere, and there could be other things to do with your money. But if you want someplace, you want your safe bucket, right? Then maybe you try and I don't know what type of account this is. You might not be able to invest in the same type of account, but you want to start your savings account or your IRA or whatever, and you put in a windfall of money. Boom. You can still do it. If you've got that windfall of money, you can start with 80 grand and get back on track, I guess is what I'm saying.
Yeah, absolutely. And that'd be, if you have that money, that's a good idea. And this is, I'll clarify, this is, it's a 9%. It didn't really matter what kind of investment it is. This is based on 9% interest.
9% interest, right?
Yeah.
Which you think is pretty feasible, right?
I mean, absolutely.
Like, I see a lot of the safe stuff. And in real estate, it's like a hard money lender. They might be like 9, 10, 11, 12%. And so I see a lot of people, I'd be happy with 5%, 6%. And yeah, some years like it's going to fluctuate, but you want that average to be there, right? Yeah. Overall. And so I do think that 9% is an attainable goal. Correct me if I'm wrong.
No, absolutely. 9% is very attainable.
Yeah.
And there's different investment strategies depending on your age. So with us, we can still afford to take a little bit of a risk.
Right.
Right. And really you say at risk over time, the market's going, even if we go into a lady told me the other day, she ended up, I felt bad. She was 67 years old. And so there's some mistakes she's made that was costing her. I was trying to point those out to her to, educate her without making her feel like she lost all hope. Right.
For sure. Because the reality is you haven't ever lost all hope, but go ahead. But yeah, you're in a tough spot.
Yeah. Yeah, exactly. But so when the market went down, she just kept on watching her money go down and go down and go down. It's like, I'm going to take this out before I lose it. She's like, and I lost all that money. Right. And I was like, well, you realize you wouldn't have lost all that money if you didn't take the money out, right? So, and she really didn't even comprehend that yet. So I was just trying to illustrate her. We have this Kyle's principle. We say it's actually, market volatility is good, right? If you're doing an account where you put, say this is the $100 every month, market volatility is good, right?
Okay.
And say it's for the, I can just say it. So let's say me and you're going to go buy, we're going to invest in cows, right? I've convinced you, John, that it's a really good idea to invest in cows.
What are you saying? Cows?
Cows, like that you milk and.
Like, cows. Okay,
yeah,
cows. Okay,
COWS.
Yeah, okay, got you. Yeah. I thought you were like cows, like I don't know what.
The Cowboys or something.
Yeah, I don't know. Yeah, cows. Okay, got you.
Yeah. So cattle.
Yeah, right.
So we go, and when we start out, you're kind of unsure about it, but you think that like he's a financial advisor, so I'll do what he says, right?
Right.
And so cows are $100 a cow. So we go out and we buy one cow for $100. Okay, and then stuff starts to take a turn for the worst, right? And it goes down to $50 a cow. So you feel like we've just lost all this money,
right?
And Blake, I don't know about this, man. I thought but all right, whatever. So, but now we get $100 a month is what we're doing. So we bought 2 cows that month, right? It goes down again. It goes down to 25. Right. Okay, and now you're just cussing me.
Oh, I know where you're going with this. Yeah.
Right, and so you get the idea. So, but we bought how many? We bought 4.
4 cows. Yeah.
Right, it goes down to 10, and that month you may be out at this point. Which if you're out, you just lost all your money.
Right.
But I bought 10 cows that month. Right, and then the market starts to go back up.
Yeah.
And because the market went down, and it'll just go back up to 100.
Right.
So if you're just investing money in a stock and it went down and never went back over 100, like, it never went back over 100. You're an idiot,
Yeah.
right? But I have all these cows now at $100, and I've actually made quite a bit of money now
Yep,
because
for
I
sure.
bought all this when it was down. So if I am just putting money aside every month, it doesn't work the same if it's just $10,000 right now.
Right.
Because you want it to go up in that
Right.
sense, right?
Right.
But if you're just doing $100 a month, market volatility is very good for you.
Right.
And that's how most people are with IRAs and 401ks. It's a monthly contribution.
That's interesting because I've heard that concept in the way of like, when real estate tanked, right? Everybody in 2008, 9, 10,
Yeah.
when everybody said, man, I wish I would have just bought all the houses up, right? At that point, it's because that market volatility took it down, right? And so
Right.
somebody that was investing in homes in 5, 6, 7, if they had the ability, and I know we're talking about a different level of financial need to buy a house versus $100 a month.
Right.
But if you're able to keep on going and keep buying houses when the market goes down, man, those guys that were able to keep buying houses when the market went down in 8, 9, 10, 11, 12, if they sold them in then 15, 16, 17, 18, wow.
Tons of money, right?
Tons of money. Tons
Yeah.
of money. And that's that same number that you were talking about on steroids in a way.
Yeah.
But the principle is the same. And so it doesn't necessarily matter if you've got $50 or $100,000. The principle is the same thing, is what you're following, right?
Yeah.
And so and by the time you're 60, if you do it early enough, or 70, then you can build that wealth that you're talking about.
Yeah, absolutely. I mean, I think investing in real estate is a great idea. If you can, learn how to do it, and
Sure.
and that's a good point with up top and the time value of money. If you invested your $6,000 and you're just trusting that 9% and you can cash out 2.2, you take that money and learn other investments too, because you
Right.
already got that built up.
For
right?
sure.
So it frees you up
For sure.
to have other options with different investments also.
Right. So, man, as we kind of wind down
Yeah.
a little bit, if you, and this is, I'm kind of putting you on the spot here, so if this is something that you want to think about or whatever, just, whatever, but you could do one thing like with your money, right? Like it doesn't even have to be the first thing, but what's the best thing? You've got $20,000, whatever. Like where are you starting? Where are you putting that money, right? Like,
Yeah.
Are you putting it in an IRA? Are you putting, and I want to give you a chance to think about this, so I'm going to throw out a few things. You putting it in an IRA, you putting it in a real estate, you putting it in a fund where somebody else is going to invest the money for you in real estate. Like, where would be your ideal spot? And I understand that it's going to be different for
everybody, yeah.
for
depending on
everybody,
the
right?
situation.
Depending on situation, even depending on the level of aggressiveness of you versus another financial advisor, they're going to have some difference of opinions.
100%,
So it's not
yeah.
going to be a hard and fast rule. There's no doubt about it. But from your opinion, what are you doing?
Yeah, no, and that's a great point. There's not one way to skin the cat.
Yeah.
And I've had, since I got in this, man, I used to just be, like I said, big numbers. I'd go out and invest in a biopharmaceutical company.
You told me about that one
yeah,
time.
Yeah. But, it'll hit sometimes.
Yeah.
But now, so.
Mine didn't hit. But
Wasn't something I gave you advice on, did it?
No, it wasn't.
Okay,
It
good.
wasn't. No, it wasn't. But my brother and I were talking about it, and we're like, man, this, it was trading at like a freaking $1 or something like that. And we're like, but they're doing this research, and if this
Right.
research hits, then
Yeah, it's all based on FDA approval if it gets approved or not.
Yeah, right. So no, it didn't. It wasn't.
That's not what I'm advising, by the way.
Yeah, right. Yeah, don't do that.
So usually, and like I said, all the stuff that I talk about, I have all these products, I have all this stuff. This is what I do with my money. So I'll tell you what I am doing. So there's something called broad-based blue chip mutual funds.
Okay.
And so for the last 70 years, it's averaged 13%.
Right.
So if I had $20,000, and I would, invest in, like I said, invest in real estate, I think it's a great idea.
Mm-hmm.
If I just had 20 grand to get started right now, I would invest them in broad-based blue chip mutual funds. It's a mouthful sometimes.
Sure.
But just based on history, it's still aggressive because 13% on your money is good.
You're right.
That's what they've averaged for the last 70 years.
Wow.
Which is really good. But the cool thing about, we call it aggressive. All that means is that when you if the market were to go down, I don't have to pull it out now. Right, so I have the opportunity. If somebody is 75 years old and I need to take my money out, and they just happen to have to take their money out when it's down, then that's not a very good look, right? So we're young, we don't have to take our money out right now. It's wealth building, and
So
we're just
that's
going to leave
interesting
it.
because my investments, like, they're all set on like max aggressiveness, right?
Yeah.
Like whatever. And so I didn't realize that that's kind of what it's based off of. I thought that max aggressiveness was like, dude, you could just end up losing all your money. But that's Is that pretty unlikely?
Well, I mean, there's always risk,
of course, yeah.
right? But honestly, unless you cash out, or unless they actually just belly up and go bankrupt, and this is not, there's another principle with the mutual funds. You just invest in one stock. That's an elevator on one string, right?
Right.
It snaps, the whole thing goes down. You could lose all your money. Mutual funds are
awesome.
like an elevator with 15 different ropes on them. If one tanks, you're still good.
Right.
Eventually, or as a whole, those 15 strings are going to gradually continue to pull it up.
Right.
And so, it's actually much less risk than I'm used to.
Right.
So
yeah, sure.
I would do that, get that started, and then look to some other investment, like real estate, where you can take a little more risk, have some time. So
right.
So yeah, that's what I do, and that's what I've learned.
Awesome, man, dude. Well, I appreciate it. It was a wealth of knowledge today.
Yeah,
it really
man.
was.
Yeah,
I
it's
had
fun.
a great time chatting, reconnecting, all that stuff. So I really appreciate it. You guys, we'll link some stuff in the description for Blake, some contact information if you want to give that out. We'll just do all that in the description if that's cool with you.
Yeah, absolutely.
We'll have all these documents that he was referring to, and there's a ton of knowledge and wealth of information there. And so if you want to dive into that whenever y'all are after watching or whatever, or maybe download it and follow along, that could be a good thing to do as well. But man, we appreciate it. And so
Yeah,
it was
appreciate
awesome.
it, John. Yeah.
All right.